Good morning, everyone, and thank you for joining us. My name is Ashley Brown, and on behalf of KLR and our affiliate companies, welcome to our 2024 year-end tax and business planning webinar. I'm sure you are all looking for ways to maximize your tax savings and wondering what lies ahead for 2025, especially in light of the recent presidential election, the looming sunset of the TCJA, and the ongoing impacts of the Secure Act 2.0. So today we're going to cover all of that and answer all of your questions on our webinar. I'm joined here today by Laura Gilanis, Partner and Director of our Tax Services Group, Anthony Mangiarelli, Partner and Director of our Strategic Business Solutions Group. Good morning to you both.
Good morning.
I'm going to cover some quick housekeeping notes before we get started, and then we'll dive right in. I want to let everybody know that a link to the recording of today's session will be sent via email this afternoon. And webinar attendees will also be the first to receive a link to download our 2024 year-end tax planning guides for individuals and businesses. So with that, I'm going to turn it over to Anthony.
Thank you, Ashley. And once again, good morning, everyone. Thank you in advance for your time and attention. A little sentimental today because we're celebrating a little milestone. This is our fifth year where Laura and I present this session together. Laura, most importantly, thank you for carrying me all these years.
I wouldn't do it without you, Anthony.
I want to go back. I'm going to share a little secret. There we are again. Most people don't know that our amazing marketing team is so great that they are also good at cut and pasting. So a little secret, that head on my body is actually from a different picture that they cut and pasted years ago, and I just figured I'd share that with the 50th year anniversary. Now you've seen it, you can't unsee it. Today's agenda is pretty chock full, but we're going to start with some immediate breaking news that I'm sure is a welcome sign to most people. On December 3rd, the U.S. District Court for the Eastern District of Texas has suspended the implementation of the Corporate Transparency Act, beneficial ownership information, that's that BOI, and we're awaiting further communication from FinCEN and the U.S. Treasury for additional guidance on this injunction. But let me caution you all that Laura and I and CPAs are educated tourists in this area. Our advice is to speak with your legal team and don't ignore the potential BOI reporting that's due by December 31st of 2024, because our understanding is this nationwide injunction was issued by a Texas district federal court, which is the lowest level of federal courts. And there's some possibility that they don't have the power to issue an injunction for other parts of the country outside of this jurisdiction. So our advice is, while there's other cases pending, please speak with your legal team and don't ignore the BOI because you think you've got a pass with this news. But it is breaking news, just happened this week. So we wanted to get that out to everybody. Other items we will be covering today is very similar to last year, but we've got a little bit further news on whether or not some of these items will be extended or implemented. So Laura will cover the status of the Tax Cut Job Act changes set to expire in 26. We have an additional update on Secure Act 2.0. ERC, it's Groundhog Day. It's still here. Employee retention credits. We'll go over the latest update on that, as well as 2024 election tax policies, what we've heard on the campaign trail and what we think will be implemented and when. And then we'll talk about what's in store for 2025 and beyond. So with that, we're going to get into the TCJA, and I'll kick it over to the FABULOUS, Laura Gilanis.
Thanks, Anthony. So will they or won't they, right? Is TCJA going to be extended? We don't know right now, but along the campaign trail, incoming President-elect Trump has said he's made overtures that he'd like to make it permanent. Don't know if that can happen. There are reasons why it was a temporary provision to begin with. It couldn't be made permanent because of budgetary issues, those roadblocks are still in play. I think we can be expecting an extension at least of probably most, if not all, of the provisions, but it does help to kind of go through what is set to expire so you can get a sense of what might happen and what an extension would mean. So the provisions that are set to expire at the end of 2025 mostly relate to individual taxation. The marginal rates right now, the highest rate is 37%. That would go up to 39.6% in 2026. Standard deduction, as you recall, when this went into play, the standard deduction at all levels pretty much almost doubled. So if this did expire, we'd go back to about half of the standard deduction, what it is now. Right now, that standard deduction is about $13,000 for individuals, about $18,000 for married, for head of household, and for married filing joint. If you're over a certain age, it could be as high as about $30,000. So those are big deductions, and it means that a lot of people no longer itemize. If that deduction went back down to what it was pre-TCJA, then we'll see a lot more people itemizing again. A lot of the personal exemptions would come back. The SALT cap would be eliminated, and I'll get into those other personal exemptions. In addition, the child tax credit would be cut in half. It was about half what it is now before TCJA. And then there is currently a $500 credit for other dependents that would be eliminated as well. So under the itemized deductions, I mentioned the $10,000 SALT deduction limit. That would be eliminated if this expires. One of the things that President Trump has talked about is he is in favor of increasing that $10,000 SALT cap. So we could see if there is an extension of this, we could potentially see an increase in the cap on that SALT deduction, which might help people, especially in the high state tax states out there. Mortgage interest, when TCJA went into effect, the debt limit of 1 million plus 100,000 home equity debt was reduced to 750,000. So some people lost out on some additional mortgage interest deductions. That could go back up if this expires. And then miscellaneous itemized deductions were completely eliminated under TCJA. That would be deductions for your investment fees, tax preparation fees, among several other things. But those are the big ones. And then also there was an overall limitation on itemized deductions before TCJA. So if your income was over a certain level, the amount of your itemized deduction would be reduced. That would be reinstated based on the AGI thresholds. Other provisions in TCJA that would, if it were to expire, we'd see a return to the AMT regime, which before TCJA, I'd have to say at least maybe 60 to 70% of returns that we looked at had some form of impact from AMT before TCJA. Since this has passed, it's rare that we see AMT on a return. Typically, you'd see it if somebody has a large amount of capital gains. You might see some AMT in there, but it's rare. So that would be a big impact on a lot of people if that were to come back into play. What else? Other expire, oh, this is a big one. The 199A deduction, which is the pass-through entity deduction, that's the 20% deduction allowed at the individual return on pass-through entities income. When the corporate tax rate was reduced to 21% as part of this, as part of TCJA, which was made permanent, by the way, for the corporate returns, those are C Corps. A lot of small business owners thought, what about us? We're S Corps, we're LLCs, we're partnerships. Why are we not getting any benefit? And this 199A came into fruition, which allows for a 20% deduction on that pass-through entity income if certain parameters are met. This was temporary. So if TCJA does expire, this 20% deduction would be eliminated. That would impact a lot of people. So I would anticipate if only certain things will be extended, my guess is this has to be one near the top, wouldn't you say, Anthony?
I would, and I'd remind everybody that this is also known as qualified business income, QBI, because for the last several years, that's what we've been calling it. And this impacts a lot of, call it middle market and small businesses. And this could have a substantial impact because these are the companies that predominantly we work with, we see, and these are the ones that are hiring a lot of employees. And it would really be tough for these companies to all of a sudden have to pay more federal income taxes while they're already struggling with inflation.
Right. And essentially, it'd be about a 20% increase in tax, right? Because income would
29.8 to 37.
Exactly. Bonus depreciation. Right now, there is a phase out in place. In 2023, it was 80%. 2024, it's now down to 60%. It's going to decrease another 20% each year until getting to zero in 2027. This one, likely every time this has come to a point of almost getting eliminated, it has been extended at some range. It's been extended to the 100% several times in the last few years, probably last decade. So I would think that this might be another one that we could potentially see some type of movement on. Who knows? I wish I had a crystal ball, but my gut feeling is that this has been a popular one to extend in the past. No reason to think that it wouldn't be on the list of high priority ones this time. Yeah. Estate and gift tax. This is another big one, although it really only impacts the top maybe 1% of income of wealth in the country, but it still is a big one. Right now for 2024, that lifetime exemption is $13,990,000. If TCJA expires, it would go back down to pre-TCJA limits, which was 5 million prior to TCJA, but that would be indexed for inflation. So I've heard the estimate of probably somewhere in the $7 to $8 million range that it might land on if expiring. So I know our estate planning attorneys that we work with are incredibly busy. They have been for several years now, preparing for a potential elimination or reduction back down. A lot of people are making gifts, and there's, again, a will they, won't they. This one is a big one because people, when I talk to clients about estate planning, the big question is, should I really bother? Is this going to get extended? What's the likelihood? All I can say is we don't have a crystal ball. This is what's in place right now, and it's best to be prepared for it. So that would be my advice on the estate and gift planning. And those are really the bulk of the issues for TCJA. Again, I think we can expect some form of extension. I doubt that it could be made permanent, although that, President Trump would like to make it permanent. I just don't know if there will be enough support on both sides of the aisle. Yes, Congress is controlled by the Republicans at this point, but right now there's only a 5-seat majority for the Republicans in the House, and several of the appointees that President Trump has named would have to vacate their House seats. That means special elections to replace those seats. So it's a small majority, and if anyone doesn't vote 100% Republican, it's not that many that they'd have to try to trip to jump the aisle. So, I don't think that it's going to be a runaway to pass everything they want. Although, Anthony, you and I were talking just before this started, the makeup of the Congress is very different than what it was in 2016.
Yeah, when you have all the three elements that control tax and economic policy now all closely tied to President Trump, it's going to swing more towards pro-business and lower taxes. And in 2016, you had some stalwarts that had been around a while that weren't in that, call it, mindset. So it will be interesting. I do think that we'll talk about tariffs later, but I do think with the bonus depreciation that kind of goes hand in hand. You will definitely see the bonus depreciation and the QBI be a hot topic because, as you said, it was temporary because they used the reconciliation process back in 2016, 2017. So we'll see if they're able to push that through now and make it permanent. That would be welcome, a couple of those facets. So let's segue into Secure 2.0. So Secure 2.0, you know, we get asked the question all the time, the RMD. This is the hot button, you know, my required minimum distribution. When do I need to take it? And for years and years, it was, you know, 70, you know, it was 72, 71, you know, it kept creeping up. So as of today, by April 1st of the year after you turn 73, you have to take your first distribution, and then thereafter every year by December 31st. So what that means is in the first year when you turn, you know, 73, you can essentially defer that first distribution into your second year. But what happens there then is you have two distributions in that second year that you're paying taxes on. So you really need to look and see what your tax situation is like in the year you turn 73 as well, anticipated what it's going to be when you're going to turn 74, and see what works best for you. The other question that comes up a lot is, you know, in RMDs, I've got all these different retirement accounts. What has to happen? Well, you have to look at all your accounts in the aggregate to determine what your RMD is. Now, you can take the required distribution from just one account, but you do have to factor in all the accounts. So it's important to understand that. And as more folks mature, we'll say, and become 73, this has become more and more, as I said, a question that comes up all the time.
And Anthony, I would add that it's not just your IRA accounts. 401k plans count, even if you're still working and if you're over the RMD age, you have to factor those balances in too. And that's where people can get tripped up because their financial advisors may know all about the IRAs, but they might not know the balances in the 401k plan. So that also has to be factored into figuring out what your RMD is. So don't get caught up by, you know, caught by surprise on that. It's important to use all of those accounts when factoring the number.
Yeah. And I will say, as more and more 401k plans have gotten away from having a designated third-party administrator who actually does the annual evaluation of the plan, the participants, and what we call the discrimination testing, that could get missed. Because in the past, you'd have somebody who was a third party overseeing the 401k plan, and they would look at this at the end of the year. As the government has tried to make 401k plans more popular for companies, some of that work has gotten bundled with the custodial work, and it may get missed. So that's a good point, Laura, that don't assume that whoever's running your 401k plan will realize that you are of RMD age. Simple and SEP plans can now have a Roth IRA contribution made to them, and keep in mind the Roth came out approximately 25 years ago now, it seems, and what that is that's a contribution to a retirement account where you don't get a current year tax deduction for it. However, the account is allowed to grow, and when you take money out, it's income tax free. So essentially the earnings, you don't pay income taxes on it. So we do encourage that if you have children of certain ages, you know, 16, 17, and you own a business, it may be something to look at when we talk about tax planning to get them to start and to do Roth IRAs as quickly as they can, because that's a good long-term solution. Additionally, the penalty for failing to take your required minimum distribution has now dropped from 50% to 25% of the RMD that you did not take. And if you realize you did not take your RMD, there's an additional possibility where you could get that penalty to be as low as 10% if you correct it within, I believe, 2 years of finding out that it was missed.
And Anthony, let me add to that. That penalty is cumulative. So if you find that you didn't take it out this year and you don't take it out next year, the penalty will continue to accumulate based on the balance you haven't taken out. So you got to be very careful about that because the penalty can creep up to a pretty high number.
Yeah, and before you know it, you have nothing left in your retirement accounts because you're paying penalties.
Right.
Another interesting component of the law was that employers can now match contributions to employee student loan payments. So if employees make student loan payments and they don't have the ability to have funds put into the retirement plan because they don't have the ability to with the cash flow, the employers can match into the retirement plan based on the amount of student loan payments made by the employees. Now this got a lot of, call it, attention when it first came out. I can tell you in practice, I get asked about this a lot, but we rarely see this happening, and maybe in the future we will, but as of today, we rarely see it, but it is something that gets a lot of attention. As does the next one, where amounts held in a 529 plan can now be rolled over to a Roth IRA if they're unused. And so there's a lot of limitations and restrictions apply, but let's keep this in mind. You contribute funds to a 529 plan for a designated beneficiary, child, grandchild. The problem's always been, what if they don't go to college? What if they don't use all the funds? Well, yeah, you could switch beneficiaries, but now if you can navigate this path, that beneficiary can have up to $35,000 of the 529 plan actually rolled into a Roth IRA, which is a welcome provision. 401k catch-up contributions for participants earning over 145,000. Those catch-up contributions for the over 50 must now be Roth contributions, and there's a transition period allowed. But the thing I'd say about that is, if you're somebody who's in HR or somebody who owns a company or is in the C-suite of a company, you got to make sure with all these provisions that your plan document has updated, and your plan and who you're working with, your providers, have the ability to make sure that they can implement all these changes. So it's good to check in with your plan document as well as your advisors to make sure you have all the provisions adopted. What else? Oh, we've got part-time employees are now eligible to participate in a 401k plan after 2 years of service. Now, in the retirement plan world, what people don't realize is if you have a retirement plan that you sponsor as a company, on the first day of the plan year, if you have over 120 eligible participants, you need a retirement plan audit. And in the past, before Secure 2.0, participants were those that are currently working for the company with balances in the plan, those that no longer work for the company with balances still in the plan, and those that work for the company that are eligible for the plan but choose not to participate. Well, what happened was they dropped from the eligible participant count employees that work for the company that don't participate in the plan, which dropped a lot of required plan audits. But now what we're seeing is, with some of these new rules that allow part-time employees to get into the plans quicker, you're seeing those counts go up because now there's employees that are actually participating in the plan that in the past weren't because they were part-time employees. So the count is getting up there. So you need to revisit that on the first day of your plan year because you may need an audit. Additionally, we've seen the involuntary cash out provisions of these plans be able. In the past, what that meant was if somebody left the plan and left employment of the company and they had 5,000 or less in the plan, you could get the money out of the plan through an IRA or get them the cash if it was under a certain dollar threshold. We're now seeing that threshold jump up to 7,000, where if somebody leaves employment of your company and they have 6,500 in the plan, you can now involuntarily move them out if your plan document is updated to allow for it. So that's something else to keep in mind. Some other things that are in there in Secure 2.0, employees can self-certify hardships, which takes some responsibility off of the plan sponsors, because employees, you would in the past have to provide certain documentation, and the plan sponsor would have to determine whether or not it was technically eligible for a hardship. The next one, catch-up limits have been increased for participants age 60 to 63, and it's the catch-up limit has now been increased to the higher of $10,000 or 150% of the regular catch-up amount for a 401k plan, and that catch-up is now $5K for a simple. So let's put some numbers to that. If you're age 62 and right now the over 50 catch-up is $7,500. You're now eligible to put 150% of that in on top of your initial contribution. So if you're over age 60 to 63, you'd be able to put in $11,250 because that's 150% of 7,500. Lastly, mandatory auto enrollment for most newly established 401k and 403b plans. So employees now have to opt out. So if you're hiring new employees, most plans now have a mandatory initial 3% auto enrollment for employee contributions into the retirement plan with an 1% escalator each year that goes up until the employee's contribution is 10% of their compensation. You really need to communicate this with employees because if they're not aware of it, you're not doing anything wrong, but they don't understand it. So HR finance needs to speak on this. You need to make sure that your plan document is in fact updated, and you need to let employees know that if they want to opt out, that they have to actually opt out. The opt-in is mandatory. One other thing we'll cover is that non-spousal beneficiaries of inherited IRAs. There was a question when this came out, because in the past, if you inherited an IRA and you were not the spouse of the person that passed, you could stretch out pulling the funds out of that IRA over you as the beneficiary your lifetime. And now that stretch lifetime has now actually been changed to a 10-year limit. So if you inherit an IRA from a non-spouse, you need to take the distributions out within 10 years. And then the question came up, well, can I wait 9 years and take all the funds out in 10 years, in year 10? That is not allowed. You must now take it out over the 10 years. You can't not take the distributions for 9 years and take out the lump sum in year 10.
That was a question that a lot of people had when this first came out into 2020. So a lot of people did not take their RMDs because it was questioned. There were final regulations that came out over the summer of this year to regulate that now you must take something out annually over the 10-year period. You can't just push it all off. So they did give transitional relief so that people who did not take their RMDs between 2020 through the end of 2024 will not get penalized, but they have to pick up in 2025 and start taking those distributions. And it's not starting the 10-year period in 2025. If you inherited the IRA in 2020, you now have 5 years to take out the balance. So it could push people up into a much higher tax bracket because you now only have 5 years to pull out that money.
Yeah, these are the items we see a lot, especially this time of year.
Mm-hmm.
So that's it on Secure 2.0. Next, we're gonna talk about the employee retention credit, and it's 5 years later, and I still can't believe that this is part of my daily life. If you go to www.conlitwin.com, you can look at the various presentations we've done over the 5 years on the ERC, and you can see me age in slow motion, as well as you can see the like I said, the head that's on the body. They haven't changed that picture, but why we're still talking about this is that last year when we had this seminar, we talked about that we were starting to see audits happen on these ERCs, and I can tell you that the audits have continued this year. But what's interesting now is we are seeing flat out denial letters now come from the IRS on claims, where they're just mailing a letter to somebody that applied for the ERC saying, no, you're just flat out denied. And now you need to take certain actions to appeal. And we'll talk about that. And we're gonna hear about ERC until at least 2027 is my guess, because of the statute of limitations on it. So just to remind everybody, what happened is that ERC was a COVID era provision whereby you could file and amend your payroll tax returns to get credits if you kept employees on payroll for 2020 and the first 3 quarters of 2021 predominantly. But what happened was there was a lot of fraud in the, call it, program. And on September 14, 2023, the IRS essentially said, we're done processing any claim received after September 14, 2023. They put a moratorium on. And so what's happened since then is that, to file an ERC claim for 2020, the window closed on that as of April 15, 2024. But you can still file an ERC claim for 2021 if you file it by April 15th, 2025. And the criteria were you either had to have a full or partial suspension of operations during 2020 or 2021 through a government order, or you had a drop in gross receipts. And seeing how 2020 is closed, we'll just talk about 2021. That drop in gross receipts, you had to have a 20% greater drop for the same quarter of 2021 compared to 2019 to be eligible for that quarter. So we've seen a lot of people apply for this because that was pretty standard back in those COVID days. Where we saw a lot of the fraud was on the shutdown orders. You had bad actors out there saying that, well, you're eligible because of the shutdown orders, but you really had to dive into whether or not they impacted you. And as I said, there was a lot of fraud. And what happened was the government just said, we can't keep up with this. We have to do all sorts of research and see if these claims are actually legitimate, because they were paying out dollars in the billions. So September 14, 2023, no processing was done for any claims received after that. And I can tell you, over the last year, we saw a lot of audits. And most recently, in August of 2024, we started seeing the IRS to process claims again. And we've seen checks arrive in people's mailboxes. And keep in mind, I mean, they've been waiting for these funds for a long time. And so when these checks show up, sometimes there's some big interest attached to it, because these are big claims, hundreds of thousands of dollars, and the government is paying interest on these claims as well. So if you filed for a claim, keep an eye out on it, because it may show up in your mailbox. Now, interestingly enough, the government is still not processing claims that they received after January 31st, 2024. Stay tuned to see when those begin to get processed, or if the government takes additional action on those. Now, one thing that did come out of this is that with all the fraud, the government put a withdrawal process in place, whereby if you felt that you had improperly applied for the employee retention credit because you received aggressive advice, the IRS would allow you to withdraw your claim, and you would only have to pay back 85% of what you received, because they know in most cases you probably paid 15% thereabouts fee to a company to do the work for you, and you could pay back the 85% and not be prosecuted if it was an invalid claim. But you had to let them know who was the provider you worked with, and the window for that recently just closed, but keep in mind that may reopen. The issues we're seeing now is that as these checks show up, you were supposed to amend your 2020 or 2021 tax return for the ERC claim when you made it. If you have not done that and you receive a claim, please speak with your tax provider so we can lay out a process to best advise you on how to pay the taxes associated with that claim. As I said, we're seeing denial letters come out right now. And when I tell you that the IRS, some of these denial letters are just flat out wrong. So we've seen 2 in the last week, where one, it came back that it was a restaurant that they basically said you weren't eligible for the employee retention credit claim that you made for the Q3 of 2021. So the quarter ended September 30, 2021. And therefore we're denying your claim. The problem was the company never applied for a Q3 2021 claim because the shutdown orders in Rhode Island and Massachusetts ended May of 2021. So as I said, just because you get a letter from the IRS, don't panic. They may not be correct. One of the other letters we received said that the company wasn't an eligible employer. The company's been in business for 20 plus years. Based on all the hoops we jumped through, the employer was definitely an eligible employer of employees. So we've been in the business of filing appeals, and the challenge with this is that this is not a standard process. So if you get one of these letters, you must, to strengthen your appeal and claim protection, you must respond to it in 30 days, and you must include a lot of detail for eligibility. And please, 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 if you get one of these letters, don't sit on it, because it takes a long time to prepare this package and get it sent certified mail to the IRS. And unfortunately, the burden of proof to appeal this is on the taxpayer, not the IRS. So I'll leave it with that. We've got samples in the past of what the audit letter for an ERC looks like. But what we've added this year is we've actually added a sample of what the denial letter looks like. So this is a denial letter received recently in October that basically says you are not eligible, and this is why. And this is one of the claims that was an eligible claim, and we had to file a very detailed response. And so also attached to ERC is PPP loans. If you remember them, this is more just an update that, not an IRS thing, but the SBA is still auditing these. We are still seeing these 5 years later. We are still helping clients with PPP. So and we've said this for years, our recommendation is this time of year, it's always good to dust off your folder and just spend a few minutes looking back to make sure that, one, if you took a new job and you're now in the CFO, CEO, or controller of a new company, make sure you have all this documentation available, or you know where it is, because these notices are still coming out, and it's good to have it handy, because you don't want to be digging for it when you actually get the notice. And if you can't find the information, we'd stress to please stop pulling it together in anticipation of something possibly happening. And with that, we're gonna go over to Laura for the 2024 election tax policies.
Yeah. So really, we don't have a crystal ball, right? We don't know what's going to pass, what's not. I think we can be certain that there will be a lot of activity over the next year. I think it's improbable that it will impact 2024 tax year, although some of the more beneficial provisions could potentially be made retroactive. I know one of the things that people are really interested in is the R&D, the Code Section 174. There's always been broad support to change that ruling, where now we are no longer allowed to deduct those costs. We have to capitalize them and deduct them over 5 years or even 10 years if you're an international company. So there's a lot of hope that that could be made retroactive, but again, no idea, right? We don't even know if it'll get passed to change going forward. There is broad support for it, but in the past several years, all that broad support for that one provision isn't enough to get that into another tax act and get it passed. So that's been what we've struggled with on the R&D front. We already talked about TCJA extension. That seems likely in some form, not maybe, I don't think that it would be made permanent, but I would think that there will be extension on most, if not all of those. But again, this is just my gut, nothing to really back it up. Tariffs are huge. You want to, you kind of opened the door about tariffs, Anthony. You want to give your thoughts on that?
Yeah, I mean, I think this has been the conversation as we approach here, and a lot of business owners have said to us that bring in product from overseas. They've said, this is the one that scares them. Is there going to be a 20% tariff on products brought in from China? What about Mexico? We don't have a crystal ball, and what I've told a lot of business owners is that please keep in mind that our economy is, while we want to bring manufacturing back, while we want to rebuild that in America, it's going to take time. And if you just slap a tariff automatically on, we're not going to be able to keep up with the local demand that is required for these goods. And these are necessities. Think about it. These are goods that we use day to day, everything from food to computers, technology. So, I don't know how much of it is more of a threat to get these countries to the table to try to get some favorable treatment for the U.S. and these other countries depend on the U.S. economy. So I think it's one of those where, will something happen? Probably. Will it be as aggressive as the media has been showing, and that that was said on the campaign trail? Possibly not.
Yeah, I think one statistic that I heard, and it's just something I heard, I'm not sure if it's true or not, maybe you could opine on it, but one of our the country we export the most to, I believe, is China. And so that if we impose those tariffs on China for bringing stuff here, they could retaliate in the same vein, right? So, there's, again, I think it's probably more likely to bring people to the table to negotiate better terms, more of a threat. Will we see some tariffs? I'm sure we will. I just don't know to the full extent.
And that's why we need bonus depreciation, so that you can get 100% write-off in the year that you pay for the good.
Yep, exactly. So another area that was talked about during the campaign related to tip income, overtime income, and Social Security income, there was comments about making all of that tax-free. I don't know how that happens, because that is probably a large amount of revenue that is generated from that income. You think about all the hospitality industry workers where their main source of income is tip income. So we'll see if there's any type of movement on that, or if that was just, and both sides of the campaign trail were talking, especially about tip income. We'll see if that was more of a, let's throw this against the wall and see if it gets me more votes, or if something actually happens on that. I'm not optimistic that there would be any major change in that area, but it's worth mentioning. Again, yes?
No tax, do they mean income tax or payroll tax?
Right. Yeah, of course, no details with some of these things that get thrown out there, but it definitely probably got piqued enough interest from certain people that those groups said, oh, I like that idea, so let me vote for you. We talked about the increase in SALT cap. That could be likely. We'll see. One of the big areas that both President Trump and incoming Vice President Vance has talked about a lot is their displeasure with the green energy incentives. I think we're going to see a lot of movement on that, whether things get passed or not. But I think we'll see some things introduced to eliminate part, if not all of that. Now that's the $7,500 credit for buying electric vehicles. There's the credit for manufacturing certain green energy equipment or infrastructure. Those are really big revenue generating type areas, because it created a lot of manufacturing jobs within the country. So I would be surprised if they got eliminated entirely, but I know that there is a lot of opposition to those incentives. Anything you want to add on that?
No, as I said, we've been on both sides of it. I'd remind everybody that some of the Inflation Act had certain credits that were transferable, these energy incentive credits, and we have worked with various brokers and clients to get the credits secured for them, whereby if you owed $100,000 in tax, you could pay 90 cents on the dollar to get some of these credits. And so you settle a $100,000 tax for $90,000. So we have seen some of that. It has slowed down a bit, to be honest. And I do think that you will see some things pass that will take away not just the eliminate the electric vehicle credit, but eliminate some of those other green energy credits.
Yeah, so it's going to be an interesting year on that front. And then the other thing that was talked about on the trail was a reduction in the corporate tax rate. These are for C corporations. Right now, it is a flat 21% tax rate, which dropped from a high of 35% before TCJA. It dropped down to a flat of 21%. I've heard 15%, I've heard 20% tossed about, but again, that would require finding ways to replace that revenue from that drop in tax rate. So those are the major things that we heard about during the campaign. Any other areas that you think I missed, Anthony? Okay.
No, I think you got all the highlights. It's just a matter of we don't have a crystal ball. Stay tuned.
Right. It's going to be I think it'll be an interesting 2 years for sure. In 2 years, there'll be the midterm elections that could potentially change makeup of the House, but who knows, right? So for at least 2 years. But remember, again, in 2016, the Republicans controlled House, Senate, and presidency. And we got TCJA, sure, but it took about a year for that to get pushed through. So it wasn't a slam dunk. So we'll see. It'll be an interesting couple of years.
Mm-hmm.
So let's jump into tax planning strategies to consider. Since there weren't very many changes, if at all, during this year, it's kind of back to the tried and true planning strategies. Defer income as much as you can, accelerate your expenses to the extent you can. If you're thinking about buying equipment for your business, think about doing it before the end of the year to get the big write-off. Again, it's only 60% for bonus, but if you have income and can absorb the loss, you also have the Section 179 expense that is up to I believe it's $1,330,000 that you can deduct, but you have to have the business income to be able to absorb that loss. It can't create a loss for you. So there are those areas. We talked about R&D expenditures, potentially repeal of 174. That has not happened. So as of right now, we are still subject to capitalizing those costs. NOLs are limited, those are net operating losses, limited to 80% of taxable income. So we can't use an NOL to fully offset taxable income right now. Interest expense, we still have that limitation. If most businesses are going to be exempt from this, most small businesses, I should say, and a small business is considered anyone with less than 27 million gross receipts over a 3-year average period. So, but there's still, this does impact some larger businesses where the interest expense on your debt, you may not get the full deduction on that. So other things we're looking at is talking to your financial advisor, harvesting capital losses, especially if you already have capital gains for the year. You want to look at seeing if you can eliminate some of those gains with some investment losses. A lot of crypto scam losses, although given where Bitcoin is, especially this week, I don't know how many crypto losses are out there, but there were some scams out there where people did lose money. So those losses could be realized this year as well. One of the big considerations that I talk to a lot of my clients with is, people ask, should I be making more charitable donations? With the increase in the standard deduction, a lot fewer people get a full benefit of charitable deductions because they would have to be donating a lot of money to get a benefit, to get over that standard deduction threshold enough to itemize. So there's really two areas that we can look at that can help combat that problem. One is a donor advised fund. A donor advised fund, you contribute a larger lump sum to a fund that is controlled by a charitable organization. Most brokerage firms have a charitable arm, so like Fidelity Charitable Organization, Charles Schwab has one, all the major ones, Wells Fargo, I believe, has one. All the major brokerage firms have a charitable organization that you can donate your donor advised funds to. You retain control of that fund in the respect that you can direct where those donations go. They have to go to, you can donate to any 501c3 organization, any qualified charitable organization you can donate to, but you can direct when and where you do that. That gives you the opportunity in 1 year to bunch all of your donations into one, which will get you over that threshold. So for instance, if you know you're going to be donating, let's say $15,000 a year to charity, generally on average, for the next 10 years, you might, in year one, you might put $150,000 into this donor advised fund. You'll get a deduction for the $150,000, so you'll be well over the threshold for itemizing. But then in the next 10 years, rather than pay out of your own pocket where you wouldn't get the deduction, you are paying those donations out of the donor advised fund. So that's a really good thing to be looking at, especially if you have funds available to put in that fund, put in that charitable fund. It'll give you a big deduction, at least in 1 year. People look at this when they have a big income event. So for people who have sold their businesses and have a large amount of income that they're going to have to recognize, this is one thing that is kind of a low-hanging fruit. Let's set some funds aside for charitable intent and do it in the year of the sale so that you get that big deduction that year. The other big idea is the qualified charitable distribution. This only works if you're age 70 and a half or over and you have an IRA. So IRA owners have the ability, if you're 70 and a half and over, to direct donations to charities that come directly from the IRA, up to $100,000, and actually it's increased to $105,000, I believe, this year, 24 or 25. So let's say $100,000, you can direct from your IRA to the charity. Now, if you're already at the age of RMD, doing that qualifies as part of your RMD. And it also, instead of getting that deduction below the line, as it's called, as an itemized deduction where you might not get that benefit, you get a deduction above the line, because what it will do is it will reduce your RMD amount by the amount of that charitable donation. This is the easiest thing to do if you're 70 and a half and older and you do have charitable intentions. Most of the big brokerage companies have created checking accounts for IRAs, because when this first came out, you used to have to call your broker and say, I want to make a donation to XYZ organization, and the broker would have to initiate that direct transfer to the organization. And it became so popular that I think the brokers were getting overwhelmed with these requests. And so they now have checking accounts. So you can write out your check to the charitable organization directly, mail it to the company, and that would count as a qualified charitable distribution. So again, that's an easy, low-hanging fruit that I recommend anyone over 70 and a half to look at. Because remember, an IRA is going to be one of your worst assets to inherit. Nobody, although it's nice to get a nice big IRA inherited, but now you have to pull that money out over 10 years. So whoever inherits it is going to be driven up into a higher tax bracket. Also, it's going to be ordinary income. So the more you can do to pay things pre-tax out of your IRA and reduce that instead of using your other investment funds to, especially to make these charitable donations, the better off you are today and the better off your heirs are tomorrow. So it's really a great planning. Talk to your financial advisor if you're not already doing it, because you should be. So those are really the big areas that we're looking at. Any others you want to add, Anthony?
More, I would just add that, you know, if you are considering a transaction with your business, just remember, you know, we're talking about how to legally defer taxes. But when you let the tax tail wag the dog, you are trading possible optimization of your business valuation. So you really have to have a long-term outlook, you know, when you go into this tax planning season, because you know, if you're trying to get maximum EBITDA value, you're not going to get that while you're trying to legally defer and minimize taxation. And I would just add, if you've got inventory, now's the time to look at possibly getting rid of it if you need to dispose of that so that you get a deduction this year. Same thing with retirement plans. If you have a 401k plan and you are considering doing a discretionary profit sharing, you do have until approximately September of 2025 to make that contribution and take the deduction on your 24 tax return. So that's something to consider to get the deduction in 24, but have 9 months to make the contribution, especially if you have a lot of you know, loyal employees as well as family members that are in the plan.
So we did have some questions that were floated, and I know we're running short on time. I think we probably addressed most of these. One question for high income wage earners: is a backdoor Roth IRA contribution still allowed? Yes, it's still allowed. Talk to your financial advisor about whether that makes sense for you. Also talk to your tax advisor. But yeah, those are still allowed. There was no change in that. So I think with that, Anthony, I'll let you close out and then we'll throw it back to Ashley.
Oh, I feel like every year I get to do this, I have it memorized. So just one more time, please allow us to thank you for your time and attention as we wrap up another year. We at KLR would love to thank our clients and referral sources for the trust and confidence you've placed in us. And as I've always said, many of you know Laura and I, but we're just two of the faces of the amazing KLR team. Please know we have a remarkable team of client advisors to go along with our incredible support and operations staff. I know you met Ashley earlier. You've heard us talk about June Landry, our amazing marketing partner director, and her and along with all of them, that unbelievable KLR marketing team allows us to connect with you. And so we thank them. www.conlitwin.com. You'll find all our webinars, newsletters, blogs, catalog there. And we're always looking to grow that team of advisors and our family of clients. So please, 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 where possible, pass our name on. And on behalf of all of us at KLR, please accept our best wishes for a happy, healthy holiday season and a prosperous, low tax, profitable 2025. And Ashley, take it away.
Thank you both, and that was fantastic. And thank you, Anthony, for the handoff. I hope that this answered all of your questions. Any questions that we didn't get to, we will reach out with some communication to help you get those answered. And as I mentioned at the beginning of the webinar, all of our attendees will receive a link in our follow-up email to the 2024 year-end tax planning guides for both businesses and individuals, as well as a copy of the PowerPoint and recording of this webinar. And like I said before, please feel free to reach out to us if you have any questions. We're always here to help. Laura and Anthony's information is here. And thanks again for joining us. Have a great day. Thank you both.
Thank you.
Thank you.